Well, this is Module 30. We're about to wrap up on the Series 65-66, and it's certainly been a pleasure for me to have gone through this information with you. I hope that you have found it very profitable. I hope that we've answered some questions for you, and I hope that you have a better understanding and feel better prepared for the test. One of the things that I want to emphasize again is that if you stop and think about it, one of the reasons they have this test is to get fee income. Okay? If that's the case, then they're going to structure the thing to where a lot of people don't pass. That's the bad news, all right? The good news is we know how they do that. The way that they do that is to test on things that give people problems. What gives people problems? It's the same things that give you problems that give everybody else problems. Those are the things that are going to be put on the test. That's the bad news. The good news is that if we know that that's coming, then think about how we can counter that effect. One of the best ways to counter that effect is to take a piece of paper, and every time that you say, I get it, that's what it is. Okay, I see what that means now. Write that down very succinctly. Just you don't have to write a paragraph, just one short sentence. Okay? I even encourage people to number them off. Okay? Just number your list. Because not to tell yourself and beat yourself up and say, oh my gosh, I have 15, 18, 25 things on my list that look at all this stuff that I didn't know. No, wait. You've got 15, 18, 25 things that were high probability questions. And now you understand them. And every time you read over that list, and do it at least a couple of times a day, okay? You'll get tired of it, I don't care. Okay? Read over that list a couple of times a day. Every time you read over it, it takes your mind right back to the point where you said, oh yeah, now I get it. And you get it all over again. And if you don't, then you've either got it really solid, or it's something that you know that is a high probability for a test question. You need to go back and review it one more time so you can get that light bulb to come on one more time. Just do that. It's astounding how many of those things that you write on your list are going to be on your test. I mean, it's just incredible, okay? So do that, and as you review back through your notes and what have you, just if you haven't started that list already, just go ahead and do that, and it will really, really help you out. Okay? Let's go ahead and pick up. I think we can go ahead and finish it this time. We were on page 48, about 2/3 of the way down, had just finished the business cycle, and again, another very high probability test question area. Now we have to go to financial statements. Just like you didn't have to be a quantitative analysis, just like you didn't have to be an economist, you don't have to be a CPA, but you do need to recognize the tools that are used and what the tools are trying to tell you, because it's something that you're going to be looking at as you evaluate different companies yourself, or as you do due diligence with the research that you get from various sources. So let's start with the financial statements. And we'll start out with a balance sheet. A balance sheet is just a snapshot of where the company is today financially. And of course called a balance sheet because it does have to balance as much money on one side as there is on the other. And so what you do is that you list out in descending liquidity, order of descending liquidity, your assets on one side, and then your liabilities and equity on the other side. I have to abbreviate that there. And these two boxes are going to be the same size because there's the same amount of money over here as there is over there. If this is in descending liquidity, the most liquid asset you can have is cash. And then you go down from there. So receivables, inventory, and marketable securities is in between the two of those first two. But in any event, you go on down and you finally get down to real assets, property and equipment, what have you. Very hard to turn a manufacturing plant into money. Okay, but it has value. And then finally, way down at the bottom, you have stuff like Goodwill. Who really cares that you have a good company name, or that you bought a company and paid a premium price so that you could have access to that trade name? it's an intangible. You can't sell intangibles. All right. By the same token, over here, how long is that going to be on the books? You start out with the bills, the current liabilities. By the way, let me just kind of draw a little dotted line across here for these are current assets and these are long-term assets. And of course, then the goodwill is just something that's carried. But you have current liabilities, and then you have long-term liabilities. Over a year, it goes long-term. And down here you have equity, which is divided between preferred and common. Okay, and if you look at it, you're going to have to pay your bills at some time here pretty quick. All right, your long-term liabilities, they're going to be on the books for a while, at least a year, but then they're going to go off of the books. So they're, like again, descending liquidity here. Your preferred, under certain circumstances, you can retire your preferred, but at least theoretically, your common equity is perpetual. So, like I say, how long is it going to be there? That's the order that is put over there. Now that we've got that, we can take those numbers and we can look at several things. And remember what we said also about reading terminology backwards. Man, it works like a charm here, okay? So you've got, like I say, your balance sheet, assets versus liabilities and equity, listed in descending liquidity. Working capital. Capital means money. Let's read the term backwards. It's money we have to work with. All right? So what is our money we have to work with? It's our current assets minus our current liabilities. In other words, how well can we just grease the wheels and function? How well can we do the things that we need to do on a day-to-day basis? Or are our bills just catching up with us because we don't have enough cash, or things that we can turn into cash very quickly? So our working capital, current assets minus the current liabilities. The current ratio, that's what? This is the ratio of current to current. Current assets divided by current liabilities on a little bit longer term basis rather than just working capital. How well are those requirements that are just around the corner, how well are those covered? Okay, so that's it. There are a couple of others, probably won't get into them here. Your net worth. What you're going to do is you're going to take all of these assets, you're going to throw out to get to something like a tangible book value, you're going to throw out that goodwill or other intangibles that you're carrying over here. But basically then you're going to start up at the top and you're going to pay off all the bills. Then you're going to pay off all the debt. Then you're going to buy out all the preferred, and whatever's left over you divide it between the common shareholders. Okay, and that's going to be your net worth, your assets less all of your liabilities, and then that per common share is going to be your book value per share. And then there are footnotes. Footnotes always are going to explain different extenuating circumstances, just yeah buts. Okay, we're showing this number, yeah, but there's a certain something that's going on. You need to take into consideration. We need to disclose this. Things are not necessarily as they appear because of that kind of stuff. So unusual events, dilution, because if you have rights, warrants, convertibles that are outstanding, then those per common share numbers, that number's going to go up one of these days, and all those numbers are going to be off. So they need to give all those details so that someone can get the full picture. Now the income statement is going to follow the flow of business. And so really we can just do it off of the outline here, that there's nothing happening in a business until somebody sells something. So you start out with your net sales, net of any returns that you have. And so net sales, that's the starting point for any business to succeed, is they got to sell something. All right, so then you take out, how much did it cost you to produce that? Your cost of goods sold. How much did it cost to run the place? Your selling, general, administrative expenses. You just day-to-day operations and getting the stuff to where you have something to sell. Back those out of the sales number, that's going to be your operating income. From your operating income then, what you do is you back out the non-operating, i.e. financing expenses. So you take out your interest expense. Interest doesn't operate, it's financing. So you take it out, that's going to give you your pre-tax profit, and yes, interest is paid pre-tax in a corporation, okay? Well, if you're pre-tax, you got to pay the tax man. So you take that out, then that's going to be your net profit or loss. Okay, hopefully it's a profit after tax. And of course, the accountants have put fancy names or acronyms on all these things. It's fine. I doubt that you're going to see those on this because again, it's not the accounting test. And then net cash flow. Okay, cash flow. You've got certain non-cash charges, notably depreciation, amortization, what have you, or depreciation, where you're going to take a charge against your earnings, but you don't have to pay any money for it. So you take your net profit, you add that depreciation back in, and if there are non-cash charges, see those are going to be in the footnotes, yeah, and that'll give you your cash flow. All right, so last section, tax considerations, and really we've covered a lot of the information that's in this last section already. So a lot of it is going to be review and just kind of highlights. So we start out with income tax and interest and short-term capital gains. They're both taxed at ordinary income tax levels. Okay. Now, of course, you have your municipal bonds that are going to be federally tax-free. If you're an in-state buyer, they're going to be state income tax-free. If they're Puerto Rico bonds, Guam, territories, possessions, protectorates is what they call it, of the United States, those are going to be double tax-free from both federal and state taxes in all cases. But generally speaking, if you have taxable interest, it's going to be taxed as ordinary income, just regular wages, the same rate as that. Dividends and long-term capital gains get a favorable tax treatment. 15% right now, that's subject to change. Double check to make sure, but you may in fact see that rate on the test. But just like we talked about with regulatory risk, okay, legislative risk, that rate can change, and if it does, then be aware of what the new rates are and look for those. But it's been 15% for quite some time, and that's on dividends and long-term capital gains. The two are different. Okay, the one is income. The one is a gain of my money. A capital gain is a gain of my capital or money. My money has grown. Okay, and if it's long-term, a year and a day or over, then you get that same preferential rate. So they share a rate, but they are different. And then retirement plan withdrawals, ordinary income tax. Now this is one thing where if you see it, you really need to be aware of it, okay? Because if you see an age and a time period, you've got to do the math. That's what that question is all about. Here's what I'm talking about, okay? Bob is 50 years old when he buys whatever it is that he does, okay? 5 years later, he decides to take a withdrawal from whatever it is that he set up. Probably a retirement plan or a variable annuity, okay? So how much tax does he pay on that? Okay? And one of the answers is going to be, well, his tax rate times the amount that he took out. That's wrong. Let me read the question the way it ought to be read and the way I want you to read it, even though they didn't write it this way, okay? When Bob was 50 years old, he purchased a variable annuity, let's say, all right? 5 years later, when Bob was 55 years old, that's the way you ought to read it. He takes a withdrawal of so much money. He's in this tax bracket. How much tax does he pay? 55 years old, let's see, a retirement plan or a variable annuity, he's going to have a 10% tax penalty on the amount that's going to be taxable to him. That's what that question is asking. So like I say, anytime that you see an age and a time period, do the math. Figure out how old the guy is today, and that will cut right to the heart of the question. All right, just trust me on it. That's the way they're going to set them up. All right, retirement plans, like I said, ordinary income tax, if you're below 59.5, be sure to add that 10% tax penalty on there. And of course, the same thing with the contributed after-tax dollars that are in a variable annuity. Since you're going first in, first out, you have to take that pre-tax money off first. Okay, anything that's after tax is just a return of your capital. But in any event, estate and gift taxes, keep in mind that I cannot force you to give me a gift. Well, I guess I could, you know. The only problem is that there's a term that goes along with, last I heard, I think that they call it extortion. So barring extortion, I cannot force you to give me a gift. All right? And so if I cannot do that, then that means if you give me a gift, you have to freely decide to do so. And one of the major tenets of life is that we live with the consequences of our own decisions. So if you decide to give me something and it exceeds a certain limit, which is set up, check the limits as they change from year to year. If it exceeds that limit that you can give me without incurring a gift tax for yourself based on your decision, your choice as the giver, okay, then basically, like I say, if it exceeds that, then the excess is going to have a gift tax associated with it to you. Now, it's going to be tax-free to me because I couldn't tell you, give me a gift. Well, I could suggest it, but you could take it or leave it. It's your decision. You then, the giver, are going to live with the consequences. So excess is subject to gift tax, no tax to the recipients. And if you give someone securities, then basically what's going to happen is, the mental image I have is that you know when you give someone a gift and you forget to take the price tag off? Isn't that embarrassing? Yeah, it really is. And anytime that you give someone securities, you forget to take the price tag off because you give away your cost basis. So their capital gain is going to, or loss for them, is going to be determined by the price that you had, the basis that you paid for it when you bought it, whoever gives it away. All right? Then estate tax, again, is paid by the estate. Read it backwards. It's taxed not only on the estate, but taxed to the estate. And the estate is going to pay that tax. There's no estate tax on a first spouse's death. Okay? So the spouse, like I say, it's you don't have folks that are going to, you know, it's not going to ruin the surviving spouse's financial condition. If there's a lot of money in the estate that's all illiquid, that's where that came from. And many times, I mean, a classic case is a farm. Before they changed the rules, a lot of surviving spouses had to sell farms. So in any event, there's no estate tax though now at the first spouse's death. And there's a certain amount that is going to be excluded from estate tax. Once you get over that amount, then the surplus over that amount is going to be subject to estate tax. There's no tax to the recipient. Again, it's the tax is paid by the estate, and money sees tax once. All right. Well, you can argue with that. But if the estate has paid the tax already, then or it's excluded to start with, which they apply a 0% rate. Well, then that's paying taxes. It's just that there's no money that's due. And so when it goes out to the recipient, the beneficiary, the heir does not have tax in that case. And then securities are valued, in other words, the cost basis of the beneficiary, as of the date of death valuation. That's called a stepped-up basis. And basically what happens there is that as the accountant is looking things over, to avoid confusion, he takes that price tag off of the back. And then on the front of the certificate, the accountant's going to write down the date of death valuation to make it easy to go through and figure out what the total estate value was. Well, when he gives that to you then, as the heir, the only number you have is there on the face of the certificate, that date of death valuation. So it's a stepped-up basis. So appreciated securities, don't give them away while you're alive. Let them hit your estate, and that way it's much more tax efficient to do so. Now there's tons and tons and tons of more considerations for estate tax planning than just what we go here. But like I say, this is you just don't have enough questions to get into enough depth to ask those kind of questions on this test. So go with the flow, okay? Prepare for what you need to be prepared for. And hopefully we've covered all the bases there. If you're seeing some questions that we haven't covered, by all means let me know. We are very interested in your success. That's why I'm doing this, is to be a part of your success in passing that test. And that's why our sponsors are with us, is that they not only want to be a part of your success in passing the test, but also your success when you get into production. So be sure to visit the sponsors, click on them. If you get an email or a call, like I say, we're all on the same team. We're all working together. We all want to see you succeed. And so, like I say, hopefully we've worked as a team, and we'll continue to do so. Be sure to tell other folks about us. We appreciate that more than anything else. Good luck to you. Let me know how you did. I really want to hear those good reports. Thanks again. Bye-bye.